Hi there, Howard Friend here. Welcome to my weekly webinar. This one is on one of my own proprietary trading methodologies, which I call the 1-2 setup, which is part of the break and retrace trading methodology, which is intended to capitalize on market trap setups. So, first of all, a little bit about break and retrace and market traps. So my theory is that many of the big moves in the markets that one would want to be part of, trading, profit from, tend to occur after a false breakout of some kind. I call these setups market traps. So traps are formed when traders are caught on the wrong side of the market. Most often they form after a technical move, for example, the break of a support level or the break of a resistance level, but often they have a fundamental trigger, i.e. a news move. So I've developed this methodology, which I call break and retrace, to help identify market traps. So the buy setup and the sell setup is the inverse, the opposite. The buy setup works like this. What we have is the market in a kind of state of equilibrium, and then we get this break to the downside. So we get this kind of knee-jerk reaction where the market suddenly sells off. Now, technical theory has it that once the market breaks sharply to the downside, it means that basically there are more sellers than buyers at a given price level. So the balance of power is basically in favor of the bears. But in this situation, what I'm looking for is a setup where the market breaks sharply to the downside and people commit themselves to new short positions. They put a bit more blood into the market. And then I'm looking for this move, the break move, to be completely retraced. So basically, we get a break to the downside and a complete retracement to the upside. So what does it tell you? It tells you that once you get back to this blue line, that all of the sellers below this blue line are losing money. They are on the wrong side of the market. So that's what the pattern's for. So once we get back to this blue line, the origin of the move, then we have a situation where most of the participants are on the wrong side of the market, and it'll be their buying that will be driving the price higher. And that's where we can hopefully benefit from the squeeze. Okay, so it's typically how it forms with a technical or a chart-based setup. We get a break. So the break move occurs when the market breaks below a support level for a buy setup or above a resistance level for a sell setup. So if the break move, fails to see significant follow-through buying or selling after that initial thrust higher or lower, then those who bought or sold on or after the break will start to exit their positions. They'll start to get a bit nervous, and that will cause the retrace move to occur. So if we get back to that origin point, if all of the move of the break is retraced, then we can safely say that yes, a trap has formed because everybody who participated on or after the break move is underwater. They're losing money. And that creates the condition for a big move in the opposite direction to that of the break. Okay, so that leads me on to the bullish 1-2 pattern. So I'll talk about the bullish setup, and then I'll talk about the bearish setup afterwards. So with the bullish 1-2 pattern, what we've got, we have a market that is trending higher or has a strong move to the upside, and this can sometimes involve several what I call thrust bars, where the close is above the previous bar's high. So these thrust bars tend to make up the bullish swings to the upside. So that's the first part. So we have the market in a bullish environment, a bullish situation. Then we're waiting for the correction. So the correction is defined in this particular case as breaking through the previous bar's low. So in other words, we need to break through, if we're looking at a daily chart, we need to break through yesterday's low. So once we've done that, then we can say that yes, we have a qualified correction to the downside underway. So what we also need to see with this 1-2 setup is not only do we want to see the market break through the previous bar's low, but at the close of the bar, we want the bar to have made a lower high for the bullish setup, and a lower low, obviously. So the market, number one, breaks through the previous bar's low and also leaves behind a lower high. Okay, so if we get that pattern, once we've got that set up and then the market fails to sustain this break lower, then we start to get the retrace, the break to the downside, the retrace to the upside. Then we're looking for the uptrend to resume within a few bars. I think it's better just to show you the graphical representation, just to get your head around how the pattern looks. So we start off, excuse me, in this bullish example with the market trending higher like so. Okay, so from a trader's perspective, from a swing trader's perspective, what we're waiting for is the correction. And then once we've seen the correction run its course, then we're looking to get in the direction of the previous trend, direction of the trend. So what we have here is the market swinging up, then easing back, and then this is the first official bar of the correction, the way that we're looking at it in terms of lower high and lower low. Okay, so at the end of this bar we have a lower high and a lower low. On the previous bar we did not, so that's why it's labeled as a 1. So we have a 1 to the downside. Okay, a 1 to the downside, that's the first part, that's the break of break and retrace. Now once we've got this 1 to the downside, the objective is to wait for the market to break through the highest high for the last 2 bars. So at the end of this bar, we can then draw a blue line, or whatever color line you wish, at the highest high for the last 2 bars. So at the end of this bar, this blue line is actually up here. This is the 2-bar high as at the close of this bar. Next bar comes along. At the end of this bar, the 2-bar high has come down from here to here. This is now the highest high for the last 2 bars, basis the close of this bar. This is where the blue line goes, and this is where the buy trigger comes in for the trade. Okay, so let's see a few examples of the bullish 1-2 setup in action. Okay, so first up, lots of examples here. We've got Euro Yen, daily chart of Euro Yen, and the market starts off in bullish mode. It's trending higher. We see the close above the previous bar's high on several occasions, thrust bars to the upside. That's what we're looking for to help us determine that the trend and the momentum is to the upside. So we're seeing consecutive thrust bars here. Then the market turns after a couple of thrust bars, a double thrust as I like to call it. Market tends to turn, and then we get the break through the previous bar's low, this red line. So this red line here is the previous bar's higher low. So this is a higher low. So we've broken through it here. At the end of this bar, the highest high for the last 2 bars is here. That's the highest high for the last 2 bars at the end of this bar. Next bar comes along and finishes. The 2-bar high now is at this point. This is the highest high for the last 2 bars. This is where we buy, basis the 1-2 trading setup. So the buy trigger comes in at the blue line, just above the blue line here. So we have break to the downside, retrace to the upside in the direction of the trend. So it's a buy setup looking for the market to blast higher. Another example here, this is Kiwi dollar, daily chart of Kiwi dollar, similar kind of thing. The market starts off by trending higher. We have at least 3 consecutive closes higher to the upside, 1, 2, 3, another sign of strength. Then as a trader, we're waiting for the market to pull back as a swing trader. So what we're looking for is the market to break through the last higher low, which is this red line here, and form a lower high at the end of the bar. So we've got a lower high and a lower low. This is the setup. This is the setup to buy the market if the market does what we expect it to do. So on the next bar, we actually break through the highest high, the blue line, the highest high for the last 2 bars. That's the buy point. The market thrusts higher into the close, and then on the next day we see another thrust to the upside. In fact, one thing that I've observed by looking at markets over many, many years is that you tend to get this kind of double thrust type action, and then the market likes to turn. So you often get this kind of 1, 2 to the upside, close above previous bar's high, close above previous bar's high, and then for some reason, for whatever reason, the market likes to turn. So it's always good to think about going contrary to the double thrust, particularly in the direction of the trend. Another example here, market thrust to the downside, turns higher. So just a little bit about market structure. Okay, moving on, some more examples, this time on dollar yen, USDJPY, daily chart. And what you can see here is obviously a nice solid uptrend, but many examples here of the 1-2 trading setup that can give us some good trading opportunities for a 1-2 day trade. So first one comes here. So the market is swinging to the upside, thrust, nice double thrust there, corrects lower after the double thrust. Then we get the lower high and the lower low. That's the 1 to the downside. Remember, this pattern's called 1-2. So the 1 to the downside. Once you've got that 1 to the downside, draw your blue line above the highest high for the last 2 bars. In this case, it comes in right here. They're pretty close to each other, these two. That's the buy trigger. So on this next bar, we break through the blue line, up it goes, 1, 2, double thrust, and after the double thrust, we get the turn. Okay, so up it goes, time to take some profits. Market turns down, and then again we get another opportunity. So the trend is still kind of healthy, it's still up. We get this lower high and lower low. We've broken through, we've got a 1 to the downside. Draw your blue line above the swing high. Next bar doesn't break it. So the swing high, the blue line, the 2 bar high is now here. This is the buy point on this next bar here. Up it goes. Nice good day trade for sure. Market turns around, goes into a consolidation. We get a good 1-2 there. We get another 1-2 here. This is a really good one where the market does a reversal day. Next day breaks through this red line. That's the thing what you're looking for. You're looking for the break through the red line, the last higher low, but leaving behind also a lower high as well. So once we've got that, then we're looking to buy at the nearest 2 bar high, which is this blue line here. Buy here, boom, boom, double thrust, turn. Okay, by the way, this works on charts of most time frames. This is a monthly chart now of euro dollar. I'm not suggesting that you trade based on monthly charts, but it can give you some pretty good background information for making your trades. If you know that there is a good 1-2 setup based on a monthly or even a weekly chart. Okay, so euro dollar starts off in this bit of a range, and then we get this 1 to the downside where it breaks through the last higher low, leaving behind a lower high. That's the 1 to the downside. So now we're looking to buy the break of the nearest 2 bar high. Doesn't happen on this bar, but it does happen on this bar, this monthly bar. That's a buy trigger. Buy, up it goes. Really aggressive to the upside action, and a good place to buy the market right there based on the 1-2. So good thrust to the upside, and we get a bit of a turn. And we're still kind of in bullish mode now, where we're trending higher. We're going, we kind of sideways here, broke through resistance, pulled back, made a lower high and a lower low. There's your 1 down. Within a couple of months, couple of bars, we get the buy signal here. Buy, boom, boom, double thrust to the upside. Time to take profits. Market turns down. We get the 1 to the downside. Here's the 2, breaks through the 2. Not a particularly great one this time, but they don't all produce great profits. I guess there was a bit of an opportunity here. It was a good 200 or 300 pips, I would say, on that little intra-month move. But not a problem. Next month comes along, we get the lower high and the lower low, the 1 down. And then next month we get the buy, the real buy. This is the great buy signal here. So the 1 to the downside, 2 to the upside, we're buying here. Boom, boom. We even get a third push higher on a monthly basis. Then the market gets a bit carried away, obviously. And then we get, again, another opportunity, a lower high and a lower low. We're looking to buy at the 2-bar high, which comes in right there. Boom, boom. Really good opportunity there, based on monthly 1-2 bullish setup. Here, this is the turns out to be the top of the market. We're still in bull mode at this point, so we get lower high, lower low, and there we get the buy signal. But as it turns out, there could have been a little bit of profit there perhaps, but by the end of the month, the market was not looking too good. So maybe this one would have turned out to be perhaps not a great one, but lots of examples along the way to make money. Okay, and as I mentioned, the setup works quite well on charts of most time frames, and also not just currencies, on most liquid markets. So here I'm just focusing on cable, sterling dollar, a 15-minute chart, and we've got a few examples here. So basically we've got a situation where the market starts off by kind of trending down. We get this push to the downside here, leaving behind a 1 to the downside. There's the buy setup there. There's the 2. Boom, boom, double thrust, pulls back, buy setup there, buy. Then the market goes a bit sideways, then ramps up, all good. Then we get this correction, 1 to the downside, but within a couple of bars, here we are breaking through the 2-bar high. Boom, boom, boom. Really good opportunity right there. Okay, so as I always say, what works on the upside should work on the downside in technical analysis and trading. So let's talk about the bearish 1-2 trading setup. So how does this work? First of all, the market has to be in some kind of bear mode. So we get a sharp decline, usually involving several thrust bars to the downside, where the close is below the previous bar's low. So we start off, the market is heading down. So that kind of puts us on alert to sell the market and not to buy the market. It's always good to have a bias if that bias is confirmed by something solid on the charts. So what we've got here is a bearish bias going in. So with the bearish bias, we're just waiting for the bulls to trap themselves, and once they've trapped themselves, that's when we attack the market. Okay, so how does it work? The market then breaks through the previous bar's high, the last lower high on the chart, and it leaves behind a higher high and a higher low at the end of the bar. So we've got a situation where at the end of that bar, the higher high, higher low bar, we've got a situation where the very short-term traders are bullish, they're positive. Okay, and that's what we want. That's what we want. We want the market to kind of at least go into equilibrium, back into equilibrium, or maybe kind of skew a little bit to the other side, just to get us some really good ammunition for the move that we hope to get. Okay, so with break and retrace, the market fails to sustain the break higher, and then we get the retrace lower. Okay, and then as the trend is down, we are looking for that retrace lower to lead to a resumption of the downtrend. So this is essentially what we're looking at, the graphical example. The market starts off by trending lower, selling off, making a move to the downside, and this puts us on alert to sell the market, but only once we've got the setup. Okay, once the 1-2 is in position. Okay, so we're basically bearish, but we're waiting for the correction. We draw the red line above the last lower high, which is here, and then when the market breaks through it and then closes, then we can draw the blue line at the lowest low for the last 2 bars. Now at the end of this bar, the number 1 bar, the blue line is right there, because that's the lowest low for the last 2 bars. But at the end of the next bar, we can then move up this blue line from here to here, because now this is the 2-bar low, the nearest 2-bar low. And that's the sell trigger. That's where we sell the market when it breaks down, if it breaks down. That's the trigger. Okay. So again, let's see a few examples of 1-2, this time to the downside. Okay, so first of all, we've got Aussie dollar, daily chart. The market starts off by trending lower. We get this big down day here, then the market reverses and then starts to push higher. So we're kind of in bear mode because the market has sold off quite sharply. but we're looking for a correction before we can attack the market. Okay, so the first part of the setup is the market breaking through the last lower high, this one here, the red line, and that leaves behind a higher high and a higher low. Okay, that's your number one to the upside, your one bar. Okay, so what do we do now? We draw a blue line below the lowest low for the last two bars. Where does that come in at the end of this bar? It comes in right there. That's the swing low. That's the 2-bar low. Now, most of the time, the market doesn't break it on the next bar. It very often takes another 1 or 2 bars to do it, as is the case here. So at the end of this bar, we can now move up the 2-bar low to here. So the sell trigger has gone up from this point to this point, and it breaks through on the next bar. We can sell it here, the break of the blue line, and down it goes. Boom, boom, double thrust. Close under previous bar's low, close under previous bar's low. This is your profit potential on the trade. And as I say, very often the market, after seeing a double thrust, likes to reverse. So a good place to think about closing out your profitable short positions. Okay, this is dollar Canada daily. Now, actually, just kind of digressing a little bit, I mentioned that the main focus here is using 1-2 in the direction of the trend. But 1-2 can also be used as part of a topping situation, or even part of a range breakout situation. So 1-2 can be used in that kind of setup as well. And I'll show you a few examples of the 1-2 as a reversal pattern rather than as a continuation pattern. So this is the case here for dollar CAD. So what we've got is the market looking bullish, trending higher, all looks quite good. And then we get this pullback, this move to the downside. Now, if we're using 1-2, by rights, what we should be doing here at this point is getting ready to buy the market, because we've got a bullish situation here. So at the end of this bar, we've got a 1 down. This is a 1 to the downside. So our 2 to the upside comes in here. This is where we're looking to buy it. Doesn't happen here. The market, the trigger moves down to here. Doesn't happen. So basically, this kind of the bullish setup doesn't actually happen. And for good reason, because what actually happens here is we get a bearish setup. So now we get the break through the previous lower high, the last lower high, and it leaves behind a higher low. So this is your setup for the sell. Higher high, higher low. It's marked as a number 1. We've broken through the red line. So once we've got that 1, we put the blue line under the nearest 2-bar low. That's our sell trigger. Market breaks through it on this bar, boom, massive down day. Market then turns. So a good opportunity here to short the market as it breaks through this blue line. Okay, what have we got here? We've got euro dollar hourly chart. So we start off with euro dollar just going sideways, and then we get this little 1 to the upside. This is in late Asia, early Europe. We get a 1 to the upside, but within a couple of bars, we're breaking through the blue line, the nearest 2-bar low. Boom, down it goes. Bit of an opportunity there for the spot trader, I guess, the day trader. Market then turns to the upside, forms a higher high and higher low right there, makes a 1 to the upside, and then within a couple of bars, couple of hours, the market is breaking down. So boom, boom, nice little opportunity there. Then the market turns to the upside, and then within a couple of bars, there's the sell, big aggressive move to the downside into the US close. So even for a day trader, the 1-2 setup can be quite useful. I'd say it's not quite as good on the intraday charts as it is on the daily, the end of day, the weekly, the monthly charts, but it can offer some pretty good opportunities. Okay, staying with euro dollar, but this time looking at daily chart. So what we got here is euro dollar starts off on this particular chart making 3 consecutive down closes, including a little double thrust to the downside. So a nice little selling wave which puts us on alert to attack the market from the short side. Okay, but only after the correction. We get the correction here. We break through the last lower high, leaving behind a higher low and a higher high. So that's your 1 to the upside. Now we can draw the blue line under the nearest 2-bar low, which initially is there, but at the end of this bar, it's moved up to here. So at the end of this bar, where's the nearest 2-bar low? There it is, right there. That's for the sell trigger. Breakthrough, aggressive selling. A great opportunity to attack the market from the short side. Aggressive selling 2 days in a row. Remember the double thrust. 1, 2, market then turns. Okay, so the environment is still bearish, but we're starting to see a bit of a correction. So again, we're looking to sell the market, but only once the trap has been set. So we get the 1 to the upside here, break through the blue line here, the 2-bar low, boom, nice bearish action. Not a whole lot of follow through after the close of that day, but still, for the intraday trader, a nice opportunity there. Then the market turns, and then we get the real selling opportunity here. So we get this big push to the upside, that's the 1. And then with a couple of bars, here we are breaking down through the 2-bar low, the blue line. Boom, boom, turn around, another one. Another opportunity there, and into the end of the chart. So quite a few opportunities there using the bearish 1-2 setup on euro dollar. Okay, so just to highlight the whole idea, let's take a look at some examples of the buy and the sell on the same chart. A few examples. Okay, so first up, cable, sterling dollar, weekly chart. So we start off with the market making a bit of a sideways move. We've got this inside bar, and then the market breaks down, making a lower high and a lower low. So that's that first break to the downside. Lower high, lower low. That's the 1. That's a 1. So you put the blue line, the 2, above the nearest 2-bar high. On the next bar, the next week, the market then breaks through the blue line. That's the buy trigger. Boom, boom, up it goes. Double thrust. Big opportunity here for the multi-day trader. Lovely trade there. So after the double thrust, as I mentioned, the market likes to turn around. Market turns around, leaving behind the 1 down there. Within a couple of bars, here we are again making new 2-bar highs. Breakthrough, boom, nice push into the weekly close, although on the next week we actually get a turn, perhaps a bit earlier than usual, but certainly some opportunity there to make some money on the long side of the market. Okay, the market then goes into a downward phase, and then an upward phase, and then tops out, then goes sideways, and now we get a kind of a mirror image of this. The market makes an inside week, just as it did there, then we get the push through the bottom of the inside week there. In this case, we get the mirror image, the push through the top of the inside week. So here we are making a 1 to the upside, just as we made a 1 to the downside back there. Okay, so at the end of the bar, we now can draw the blue line under the nearest 2-bar low, and it breaks through on the next bar. Boom, boom, double thrust. There, shorting opportunity, 1, 2, same as here. And then after the double thrust, guess what? The market turns around. Take your profits after the double thrust. Okay, moving on to gold futures, daily chart of gold futures, COMEX futures. So what we've got here is the market moving to the upside and then making a 1 to the downside, lower high, lower low. So we then draw the blue line at the nearest 2-bar high. Then it doesn't break on this day, but on this day it breaks. That's the buy trigger. Break through the blue line, boom, boom, double thrust. After the double thrust, what happens? Market turns around, and this turned out to be the top of the market. The market then enters a bearish downward phase. So we have thrust, thrust, double thrust, 1, 2. Market likes to correct after double thrust, leaving behind here a higher high and a higher low. We're in bear mode. The market is in a downward phase. We sell the market at the nearest 2-bar low, which is here. That's the sell trigger. Down, 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 and again. Good opportunity from the short side here. So good opportunity on the long side, good opportunity on the short side. Here, we actually get one bad signal followed by a very good signal. So what happens is the market is in bear mode, then we get the 1 to the upside, we get this break to the upside, and then we got the sell situation at the nearest 2-bar low. Now we get a marginal 2-bar low there. That's actually a bad sell trade, but that would have been stopped out, I guess, above the previous bar's high, if not closer. But then we get a buy situation. We've got a 1 to the downside. We break through the blue line. Boom, boom. So now, having taken a small loss on this short position, we've now entered long, and we're making all the money back plus more on the long side of the trade. Okay, market tops out here, does the 1 to the downside, breaks up, little bit of opportunity there perhaps for the day trader, and then tops out. Dollar yen daily, this one starts off in bear mode, double thrust, 1, 2, close under previous bar's low, close under previous bar's low. We like to see that. That gives us some kind of confidence that the market is aggressively selling, and that we should look to sell as well when the opportunity is correct. Okay, so in this case what we get is we get the 1 to the upside where we break through the last lower high, but at the end of the bar we've left behind also a higher low. So at the end of this bar the market is pretty much bullish because all of the buyers are quite happy. But they're not thinking of the bigger picture. The bigger picture is that the market did this double thrust, and that the underlying pressure is to the downside. Okay, so we have the 1 to the upside, and within a couple of bars here we are breaking through to new 2-bar lows. So that's all these people bailing out of their losing long positions. Boom, boom, double thrust. After the double thrust, take your profits, market turns around. Okay, in this case the market then has another go at the downside, base is out, up it goes. So now we get this bullish double thrust here, 1, 2. So we've got aggressive demand here. This tells us that the market is basically positive. It wants to go higher. Okay, so what are we waiting for? We're waiting for the 1 to the downside. Market turns, doesn't break through support, but it breaks through support on this bar. This is the 1 to the downside. So now what do? We're looking to buy the market when it breaks through the nearest 2-bar high. It does it on this bar, boom, boom, and pushes higher, and that's the turn and the top of the market. So good a buy opportunity right in there, and then the market double thrust, take your profits, turns down. Okay, so now we have a situation where at the end of this bar, we're still bullish, the market is trending higher. Now we get this 1 to the downside. This puts us on alert to buy the market, but only at the nearest 2-bar high, which at this time comes in here. Okay, so on this bar, does the market break through a new 2-bar, the last 2-bar high? No, it does not. It breaks through the previous bar's high, yes it does, but it does not break through the nearest 2-bar high. That's why the 2-bar high is very important, and it's stronger than the 1-bar high. Okay, so these guys are buying the break of this resistance level here, but by the close of the day, the market is slammed lower. So that tells you something is wrong. Okay, so now this actually sets up the reversal pattern, where the market makes a 1 to the upside, higher high, higher low, and then on the next bar, we break through the blue line, the 2-bar low. That's a sell opportunity right there, 1 and 2, down it goes. Okay, back to Eurodollar hourly chart. In this example, Eurodollar starts off just doing a sideways range in Asia, as it very often does. And then we get this 1 to the downside as the Europeans come in, 7 o'clock or so, push to the downside. So 1 to the downside, we're drawing the blue line at the nearest 2-bar high, which happens to be here. And on this 8 o'clock bar, we push through. Boom, boom. Nice opportunity there for the early European intraday breakout traders here, right there. Market then turns down, sees a 1 to the downside here, and within a couple of hours, 2 or 3 hours, the market is then making new 2-bar highs. Boom, boom, lovely trade there. Reversal, double thrust, reversal, same pattern. And then, a bit like the previous example, we get a push to the upside here, leaving behind a 1, and then we can sell the break of the 2 right there, down it goes. Okay, so that's pretty much how the the concept works and lots of examples of how the pattern goes, the opportunities that it can present you. And if you look at charts, you'll see them all over the place. There've been some great examples, particularly on Eurodollar recently, on a daily chart where the market literally just breaks through the previous bar's high, leaves behind a higher high and a higher low, and then within a couple of bars, I usually use 2 to 3, within a couple of bars, the market is breaking down. So we've got lots and lots of these opportunities. Okay, so before looking at the trading strategies that I build around OneTwo, let's just talk a little bit about how to enter and exit the market. So basically, with all of my strategies, systems, algos, whatever you want to call them, I enter always on a stop. I always use stop orders to enter my positions. I don't use limit orders to enter my positions. Many people do. The reason being that what I'm doing is I'm buying strength. When the market goes up, I want to buy it. When it goes down, I want to sell it. I want to go short. So what I'm doing is I'm ensuring that I enter the market when it goes up by using a stop order. I use limit orders to take profits, and I use time-based exits to get me out of a trade after a certain amount of time has elapsed. Okay, so just to talk you through the orders. So a sell stop order is an order to sell below the current price. So essentially what we're doing is we're selling into weakness. Sell low and exit the short position even lower. That's the rationale. So sell stops are used for entering short positions and exiting bad long positions. A buy stop order is an order to buy above the current price, buying into strength. The idea is that we buy high and look to exit our long position even higher. So used for entering long positions and exiting losing short positions. A limit order. Now, these are orders to trade at perhaps more advantageous prices than the current market. So a sell limit order is an order to sell above the current price. You're selling into strength. And a buy limit order is an order to buy below the current price. You're buying into weakness. So I only use limit orders for taking profits, not to enter my trades, to take profits. So essentially, when I have a trade on, I have a stop loss, which I use a stop order for, and I have profit targets, which I use with limit orders. Time exits are simply, as I say, an exit which gets me out after so many bars have elapsed on the chart. So, for example, if I'm using an hourly chart, I might want to get out after, say, 3 hours. Or if I'm using a daily bar chart or a candlestick chart, whatever, I might want to get out after, say, 4 days in the trade. It just depends on what you're doing. But the reason I do this is because the trades that I do are momentum based. I'm buying something because it's going up, because there is momentum behind it. And momentum can turn around very, very quickly. So the reason is that you want to basically get out of the trade, hopefully in profit, before that momentum cycle can turn against you. So that's essentially what we're trying to do. Okay, so let's have a look at the trading strategies that I can use on the OneTwo buy setup. So for the buy setup, this is what we do. First of all, we need to see, for a continuation type setup, we need to see a sustained move higher. Okay, so we're looking for the market to move higher. Don't forget, we can also use the OneTwo buy in a base kind of reversal situation. Okay, so once we've seen the sustained move higher, then we're looking for that break to the downside. Remember, break and retrace. We're looking for the market to break to the downside. We want people to sell into the market, to take the market lower. And that gets us ready to buy the market, as I've shown. So the break has to form a lower high and a lower low bar at the end of its bar. And once we've done that, then we're looking to buy the market at the nearest 2-bar high. So I say over the next 3 bars. I don't think we should go on for much longer than 3 bars after that. So essentially what we're doing is we are looking to buy at the nearest 2-bar high. So what I do is I place a buy stop for 3 units of the market that I'm trading. So when I say 3 units, it could be any number you wish. The main point with the 3 units is to be able to divide up your trading position into 3 equal parts so that you get out at profit targets in a third of your position. Okay, so when I go long, if I go long, I then have to protect my position with a stop loss order. I usually put that below the low of the lower high, lower low bar. We could also use a tighter money management stop if that distance is particularly large. In terms of time exit, I've got something which I created with a bit of a catchy name, purely because I use the term Brexit. And it's nothing to do with the UK leaving the European Union. It's just basically the action that I take. It works on this double thrust situation that I showed you, where the market has a thrust bar, has another thrust bar, a double thrust. So basically you get the break, and then you exit on the next bar, like this. So essentially what we're looking for is the market to do a 1 to the downside, gets us ready to buy. It breaks through the blue line, the 2-bar high. There's the break. At the end of this bar, that's the break bar. And then on the next bar, we exit on the close. That's the idea, Brexit. Break and exit equals Brexit. Okay, I'm glad that's clear. So the sell setup is basically the buy, but in reverse, obviously. So most of the time I'll be using it in conjunction with a bearish setup. So we're looking for a sustained move lower, but also don't forget we can use the sell situation as part of a topping process, as I've shown. So a sustained move lower, then we're looking for the market to push higher, leaving behind a higher high and a higher low. That's the 1 to the upside. Once you've got the 1 to the upside, draw your blue line under the lowest low for the last 2 bars. Place a sell stop order for 3 units. That number could be 3 lots, it could be 0.09 lots, it could be any number you wish, as long as you use a number which is divisible by 3, so that if you start hitting your targets, you're getting out of 1/3 of your position. Okay, that's the idea. Okay, so if we go short, then we need to protect our position, our short position, with a buy stop, a protective buy stop, and that goes most of the time above the higher high, higher low bar. Okay, could also use a tighter money management stop if that distance is particularly big. And again, using the Brexit exit to get out after hopefully a double thrust in your favor. So market swings to the downside, looking to sell it, but only after the break to the upside, which we get here. So market breaks through the red line. At the end of the bar, we have a 1 to the upside, a higher high and a higher low. We then sell at the nearest 2-bar low on any of these days. Here we get the sell, boom, there's the break. We get out of our trade on the next bar. Break and exit equals Brexit. Okay, so just to summarize on the 1-2 setup. So as I've shown, most of the examples, the 1-2 forms during strong trends both up and down. So the 1-2 pattern is a very good way to jump on board a trade in the direction of the current trend. So that's always the objective, or most of the time the objective for the swing trader, is to identify the trend, to wait for a pullback, and then to get in when you can see signs that that trend is resuming. So the 1-2 pattern kind of ticks all the boxes for that kind of trading strategy. As I said on a few occasions here, the 1-2 pattern can also form as part of a basing process or part of a topping process. So the 1-2 pattern can often provide some very good opportunities for a reversal setup, when the market does a kind of a retest of the high in an uptrend and then starts to break down. So it gets you into the new downtrend earlier, most of the time earlier than you would get in normally by using perhaps traditional technical analysis like head and shoulders or double top or something like that. It can get you in a lot earlier sometimes. So in terms of swing traders and how they approach the market, I would say rather than just blindly going in and jumping in when the market goes up, literally. It's good, obviously, to wait for the pullback, because the pullback basically brings the market back into equilibrium after a move out of equilibrium, away from equilibrium. So that's what you're looking to do as a trader. You're looking for the market to kind of set itself up by resetting itself to equilibrium point, maybe even going the other way, and then you can jump in when you get the sign that the market is swinging back. You're looking for that momentum pendulum to swing back and forth, but in the direction of the previous trend. So as I say, the 1-2 setup is valid on just about all time frames and on all markets. Anything that's liquid, that moves a lot, that creates these patterns on the charts, can give you some pretty good trading setups. So what I'd suggest if you're thinking about using 1-2 is to just print off a whole bunch of charts, daily charts, your favorite markets, print off a whole load of charts and mark them. Mark the red line, mark the blue line. Get a feel for 1-2, and before you know it, you'll be looking to use 1-2 as part of your trading strategy. I use 1-2 as one of the components into one of my algos, so it's quite a good, powerful trading setup in my opinion. Okay, so that's before I close, I just wanted to say a few things on money management, because that is quite an important aspect of trading. So obviously, whatever setup that you trade, whether it's a 1-2 setup, or whether it's if you're trading based on Elliott waves, or you're trading based on indicators, or you're trading based on price patterns, for example, whatever it is that you do, you need to be very focused on your risk. It's very important, because the thing about trading is it's not there are no absolutes when it comes to trading. It's basically a batting average. You're going to have lots of losing trades. It's just part of the game. In fact, I think that's probably why trading can be seen as many people, they kind of struggle with trading, because they're not aware of the fact that you will have some good periods and some bad periods. And the idea is basically to win the game over the long haul. I like to use the analogy of maybe your favorite sports team. Your favorite sports team will not win every single game. They will have games where they lose. They'll have games where they draw. They might have games where they just win by a small margin. And the same with trading. It's going to be lots of ebbs and flows. So that's why when you're trading, you need to only risk a certain percentage of your trading capital on any one trade. I always say, as a rule of thumb, 2%, but again, it will depend on the risk level of the account that you're trading. So if you happen to be very risk averse, you might be risking no more than 0.2%. It just depends on your own trading psychology and risk tolerance levels. So very important to keep a handle on this. Another thing, so even the best traders and the best systems and algos, they will suffer drawdown periods. It's just a fact of trading life. And anyone who's traded for a living, I've traded for best part of over 30 years, and there are many periods where you take a series of losing trades. You just cannot make a winning trade, and that's just part of the game. But if you have methodologies, systems, strategies that are solid and that do well over the longer haul, and you keep your risk small, then you will live through those drawdown periods. So yeah, you need to be able to handle a drawdown period, a series of losing trades, before your trading strategy works and pays you back all of the money that you've lost, plus lots of profits. So essentially, that's really trading in a nutshell. Okay, and my final word, I guess, for this week would be patience. Just to be patient, to wait for the traps to form, because the traps will form all of the time. Traps are basically market psychology, human psychology. People make the same mistakes again and again and again. They get too bullish, they get too bearish, depressed, excited, whatever. And these patterns will show themselves on the charts. So you can read the charts. You can use the charts to read the psychology of the market. And with the 1-2 setup and with many of my other setups, you have a clear strategy for benefiting from market psychology. Okay, I'll wrap it up there for this week. Let's just see if there are any questions. Any questions or comments on the trading setup? Nothing straight away. Not a problem. Not a problem. Okay. I'm always available to answer any questions on the material that I. Oh, there we go. Okay, what we have. It absolutely does apply to gold. Yes, absolutely does apply to gold. That's the question. Gold is for small time frames like 30 minutes. As I mentioned in the presentation, I think once you go into the intraday bar charts or candlestick charts, whatever you're using, then they're perhaps not quite as reliable. But yes, there are many opportunities. If you're looking for something specific, for example, you're looking to buy gold or sell gold in a certain zone, maybe a retracement zone or whatever it be, then why not use the 30-minute charts and then use 1-2? It could give you a very good opportunity to get in. But yeah, I would not say, oh no, do not use it on gold on a 30-minute chart. I think particularly with futures, because futures the charts are much cleaner. And you can see real levels of buying and selling on the futures charts. But so it's better to focus on, yes, absolutely, on 4-hour and daily charts. Yes, most of the examples I showed today were on daily charts, and I would say daily charts is probably the best one to use 1-2 on, because you filtered out quite a lot of the noise by using daily charts. But again, in that respect, if you're using daily charts, you've got to think, well, obviously the bigger the time frame I use, the bigger the stop I'm going to be using as well. So you may have to use a bigger stop, but trade a smaller size. But either way, it's horses for courses, as they say. Everybody is different when it comes to trading. Okay, perfect. Any other questions out there? No, it doesn't appear so. Okay, in that case, I'll wrap it up. Thanks very much for attending, everybody. It's been a pleasure to present to you. If you think of anything after the presentation over the next few days, by all means, contact your CFI representative. They're very happy to pass on any comments, or contact me. You can find me on LinkedIn. I comment on LinkedIn every couple of days, maybe sometimes every day. So you can track me down on LinkedIn if you want to ask me something directly. Connect with me. Okay, so thanks again. I look forward to presenting same time next week, and yeah, have a good weekend, and I look forward for next week. Thank you very much.